Hello and good morning, everyone. Thank you so much for joining us for today's free webinar, How to Set Up Your Startup Accounting with Sirk Roh from Early Growth Financial Services. My name is Erica Malsberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. This presentation is going to run about 40 minutes or so. If you have questions as we go along, please feel free to enter them in the question field, or you can even tweet them to us at Early Growth FS with the hashtag Startup Accounting. Don't just raise your hand, just jump right in there with your questions so that we can see them and ask them while we're delivering this presentation. Hopefully we'll get to all your questions during the course of this webinar. If not, we'll follow up after individually. And you'll also all receive a follow-up after this presentation with a link to the slide deck and a link to the recording, so you'll be able to review those materials again if you find them useful. Okay, so on that note, I'd like to go ahead and introduce our presenter today, Sirk Roh. Last time I introduced Sirk, he said that he thought my introduction made him sound a little bit old. So I'm going to blur some of the numbers a bit this time and just say that Sirk is the Chief Operating Officer for Early Growth Financial Services. He has a certain number of years of finance experience with another certain number of years serving in financial leadership roles with high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. Is that better, Sirk?
Thank you very much, Eric. I appreciate it.
Okay, so welcome and good morning to you. Okay, so before we dig in with the content, Sirk, you want to start by just saying a few words about Early Growth Financial Services?
Yeah, absolutely. Thank you very much, Erica. Early Growth Financial Services is we are an outsourced accounting and finance firm. We work typically with small and medium-sized companies here in the Bay Area and in California. A lot of those tend to be tech startups, as you can imagine. But we also work with all other types of companies: consulting companies, real estate companies, construction companies, basically any kind of company that requires the need for financial and accounting assistance, but don't necessarily want to be hiring those people full time. We offer four types of services. We do tax returns. We do company valuations, 409 valuations for companies who provide stock options to their employees. We do transactional accounting and bookkeeping, so that's the day-to-day, the week-to-week, and the month-to-month financials, as well as preparation of financial statements. And then we provide higher-level, CFO-level type of consulting services for project-based work, such as budgeting, financial planning, fundraising, and any other type of high-level financial assistance that you might need. We have 350 plus companies, active companies that we work with. You can see some of the companies that we're currently working with on this slide.
Great. Thanks so much, Sirk. So, let's go ahead and jump in. I mean, as Sirk and I were just talking before the presentation, and, honestly, this is just intended to help you all to get started on the right foot. If you're really just in the early stages of setting up, hopefully the information we're going to give here is going to help you to do that. If you've already started up, then hopefully this will be validating to you or give you some good tips on what you could be doing a little bit better. And really, we are an outsourced financial services company. At some point, it's essential for companies to work with us, but really early stages, it may not make sense to yet. So this is actually a way for you to kind of save money and do it yourself until it becomes the right time when it's, exceeded your capacity for financial management and you need to hire some outside assistance. So on that note, do you want to give a little bit of the presentation overview here, Sirk?
Sure, sure, Erica. And I wouldn't even say this is more of an overview, but these are the things that you need to be thinking about. You want to kind of set everything up early. The earlier that you set things up, the easier it is for you to keep track. It's not expensive. It just requires a little bit of thought beforehand. Establish, obviously, a structure, both an accounting structure as well as just kind of how you're going to be managing your financials, your cash. Keep it simple. Let's keep it as simple as possible for as long as possible until you get to the pain point, and you need to get a little bit more complex and you need more assistance. But obviously, you want to keep it simple, but you also need to set up the system that will enable you to grow. The last thing you want to be doing is having to bebop from a small system into a bigger system at a later stage because you realize that you didn't set things up properly on the front end.
Great. So let's start with pre-funding then. So if your company is still pre-funded, what are the things that you need to be thinking about and doing at this stage of development?
Yeah, and at this stage, you obviously are, you've probably put in a little bit of money yourself. You might have borrowed some money from friends and family. You've got a little bit of cash, and you're really, really getting started, but you actually haven't received any outside funding. So the reporting requirements are minimal, right? You just need to know what's happening with your cash. You need to know where the spending is going. You need to have kind of a high-level understanding of how much cash you have left, how much time you have to actually raise additional funds. And so to that point, you just need to basically keep things separate and keep track of what's happening. And so the two things that I absolutely encourage entrepreneurs to do is to open up a separate business banking account and open up a separate corporate credit card. So you just need to segregate the activities that the business is undertaking from your own personal. Now, if you're an entrepreneur and you know that basically everything that you do is tied in integrally with what's happening with your company, but from a financial perspective, you do need to keep those things separate. Otherwise, there's two things that could happen. One is obviously from a financial reporting perspective, it's harder to track. And then secondly, and maybe more importantly at this stage, is the legal considerations. So, you're going to set up the company so that you have a line between your personal liability and your business's liability. If you don't actually separate out the financial transactions and there's a blurring of activity between what you're doing personally, individually versus what the company is doing, then at some point that might cause some legal issues when it comes to liability. So for those two reasons, keep everything segregated. Obviously, keep track of your receipts and invoices and basically any type of documentation. We absolutely encourage nowadays. Everyone is cloud-based. Everyone is going paperless. We strongly recommend you do that. So use the use cloud-based document storage such as Google Drive or Dropbox or Box.com. To keep track of this stuff, file them away. Don't print things out and keep them in folders. There's no reason to do that. Obviously, be mindful of tax obligations. We'll cover tax on a separate slide a little bit later. Obviously, collecting payments. If you're at a stage already where you have revenue and you have customers, then getting that cash flow in the door in as timely of a manner as possible is obviously critical. At this stage, there's probably a couple of things that you need to be doing from a process and product standpoint, and that's obviously selecting a payroll provider. If you have employees and you already have one, there's people like ADP, who's a bigger player. There's newer players like Zen Payroll, which is a great option. For smaller companies, the price point is fantastic. Everything is cloud-based. There's established players like Intuit Payroll, and then there's also the likes of a PEO or a professional employer organization like TriNet. And so if you do a little bit of research, you kind of determine, which might make the best sense for you. But at this stage, you're probably looking at something like a Zen Payroll to really get you going and making sure you're covered from a payroll and a payroll tax perspective. And then if you're obviously doing stock options, then you need to be working with your lawyers to make sure that you are staying on top of stock records. At this point, we also probably need to discuss accounting systems. You may or may not need an accounting system at this stage. If you do, then you're probably looking at, the likely, QuickBooks Online is probably the 800-pound gorilla out there. Everyone knows QuickBooks. QuickBooks Online is a cloud-based system that is very easy to set up. It's very cost-effective. There's other players like Xero with an X that's also making pretty strong inroads. Very easy, very intuitive. I would, if you're looking at the two and they're both about the same price, I would probably steer you more towards QuickBooks, just from the standpoint of they're more established. You'll find people know QuickBooks better than they know Xero. It's easier to find people who know QuickBooks more so than Xero. And so I'd probably push you in that direction. We as accountants, obviously, all accountants know QuickBooks, and so it'll be very easy to find support when the time comes.
Okay, so that's, pre-funding. So if we move on then, what happens after you've received your first round of investment capital? What do you need to be focusing on then?
Yeah, and at this stage now, when we talk about post-funding, we're probably talking about, having raised, several $100,000 or even more than $1 million of seed financing, or if you're really, really in a hot space and you have access to capital, you might have even closed a Series A round of financing for $1 million, $2 or $3 million. And at this stage now, basically you have investors, right? And once you get investors, the dynamic changes. You no longer can you just manage your finances by looking at your checking account and your credit card statements. You absolutely do need to start preparing financial statements. You need to start preparing budgets and financial plans, and maybe most importantly of all of those is a cash flow forecast, right? So if you have investors, every single time you talk with them, they're going to want to know how much time do we have to live on the current cash that we have. And so you're always going to be updating not only your past historicals in terms of finances, but also your going forward, and in particular this cash flow forecast. So you need to set up some systems. You need to set up a financial infrastructure. You need to figure out how things are getting paid and how we're collecting cash. And you need to figure out your insurance needs. There's a lot of things that you're going to be doing at this point in time. The managing of the cash flow is absolutely critical. You, as the entrepreneur, as the founder, co-founder, need to really always have the finger on the pulse in terms of what's happening with your financials, what's happening with your cash. When do we need to start hiring more people? When are we going to step up our spending? How quickly is product development happening? Do we need to be making adjustments to our plans? And obviously, what do we need to be communicating with our investors? And at this point in time, you're probably going to want to, if you haven't been doing it already, you're going to need to go to a GAAP-based financial reporting system. And GAAP, you can see this on the last bullet point, is generally accepted accounting principles. This is what all investors are used to seeing. They're used to seeing financials that are GAAP compliant and not just cash flow based or cash based. And so this means things like accruing for expenses and deferring revenues if you have people who have paid for service upfront, for example. And it's really about matching the timing of your expenses with the timing of your revenue, so that when you prepare financial statements, that they truly reflect the financial condition of the company at that point in time. And that's why generally accepted accounting principles kind of evens the playing field, so that when people see financial statements that are GAAP compliant, then they know that they're kind of doing an apples to apples comparison against other companies. And so you absolutely need to be doing financials in this manner at this point in time. And there's no reason that you wouldn't do this prior to funding. And in fact, we obviously encourage, if you have the wherewithal, if you know enough accounting to actually set up your accounting system initially to be accrual-based and GAAP compliant as opposed to cash-based. But there probably isn't a huge need for that. If you don't have that expertise to do. But once you actually are getting funding, or once you have received funding, then you'll absolutely need to move to this basis.
Great, thanks. And we have a question from Jose that kind of ties to the last slide, but he's wondering if there's a good expense tracking software you recommend, or a good app for tracking expenses. If you mean company expenses, I don't know that there is one. I would just say that you probably want to set yourself up like I said again on QuickBooks Online or Xero. You'll capture all your expenses that way. I know that there's apps like Mint.com that a lot of us use for personal finances. You can absolutely use that for
for your business as well, if you wanted. But like I said, if you are going to grow beyond just even just the simplest sole proprietorship, you're gonna want better reporting than what a Mint.com can do for you. You're gonna want to get set up on the QuickBooks Online or Xero, and those systems absolutely have all of that expense tracking capability. It allows you to download all your transactions from your credit card statements. It allows you to upload or download all of your payroll transactions, and so it's a very, very easy system to use. If you're talking about kind of like personal expenses or expense reporting of employees or your own personal expenses and getting them into QuickBooks, there are tools like Expensify and Concur that allow you to do expense management reporting as well. So I'm not sure if that answered your question, Jose, but yes, there are certain things, but I would just say that you may as well get set up for QuickBooks Online. I think it costs something like $25 a month to use, and I think it's better to use that earlier rather than later.
Great. We got a resounding yes from Jose that answered his question. So
great.
Okay, nice to have that feedback. Great. Okay, so I mean, when we're talking about the shift from pre-funding to post-funding, we're really talking about an inflection point. So along those lines, an inflection point, like what is the point at which you should engage with the financial services support firm? So when does it become too complicated to do on your own?
Yeah, and it depends, on lots of factors, obviously, right? Because a lot of entrepreneurs they already have some financial wherewithal. They already know enough accounting to be able to kind of set up a system in a simple chart of accounts and to start tracking expenses. And if it's not a complicated business, then it's something that they might be able to manage on their own. But obviously, once you've raised money, right? Like I said, the dynamic changes. There's different types of reporting that has to happen. Investors are going to want to see regular financial statements, and so if you're not familiar with the format of what they would want to see, this would be a good time. Obviously, these are just some guidelines of times when it might make sense. But I would actually point to a higher level and just say that the timing is when you feel the pain point, right? And that pain point is going to be at different stages and at different times for different entrepreneurs. So for a new entrepreneur who doesn't have any kind of financial or accounting expertise, who kind of feels lost, and even this presentation seems like, oh wow, there's so much here, and I'm not sure of really what I need to be doing, then I would say you might want to talk with someone relatively early to set up a simple chart of accounts and to do a very, very high level assistance for you. If you have more experience and expertise, then you can push it off longer, and you could do it on your own until you get to the point when it doesn't make sense, or you need to focus your energies more on running your business. Obviously, at early stages, I would point to two things that you need to be focused on. You need to be focused on product development, and you need to be focused on customer acquisitions, right? That is what adds value to your company long term. And if you are spending time on other things that aren't adding that kind of value, then I would argue that you could probably find service providers or other assistants that can help you do that at a very, very compelling price point and a value point to you, such that you're providing much more value for the time that you're spending on those important things for your company. But once you raise money, once you start having revenue, and once you have some institutional investors, you're gonna need some level of reporting and some level of expertise in accounting. Beyond just hey, I'm just checking my checking account balance to make sure I've got enough cash.
And we have a question here from Donna, who wants to know if you can talk a little bit more to setting up your chart of accounts.
Sure, I'd be happy to, and this is actually relatively simple. And obviously a chart of accounts is, for those of you who aren't familiar, these are all of the accounts that are going to that are being set up in any kind of in accounting software or even in Excel where you're tracking all your financial activities. So it's all the accounts in your income statement, it's all of the accounts on your balance sheet, and setting it up is going to be dependent obviously on the type of business that you have, right? So if you're a software company, you have software revenue, and you might have professional services. If you are a consulting company, you'll obviously have consulting revenue. So you'll set up different chart of accounts depending on the kind of company. The nice thing again about something like QuickBooks or Xero is if you go in and I encourage you to even just at least look at it if you haven't done so already. Go to the Intuit website, QuickBooks Online, and just take a look. You can do a free trial. They have templates of starting chart of accounts that you can use. They have them for different kinds of companies, and they're very, very good generic chart of accounts to start with. And the nice thing again about QuickBooks Online is you start with you'll kind of pick the kind of business that you run. They'll recommend a chart of accounts that you start with, and you'll look at the chart of accounts and you'll say, oh, you know what, I need to add this. I know I'm going to need to add this, or I know that I can make this kind of an account inactive because I'm not going to use it. So it's very, very easy to customize and just add to it as you go along. Which is one of the real strengths of something like QuickBooks as opposed to a bigger ERP system like SAP or Oracle, which is really inflexible that way. QuickBooks is very, very flexible and is absolutely the way to go for an early stage company.
Okay. Thanks, Sirk. So let's talk a little bit about accounts payable then, the nitty-gritty here. What do you need to do in terms of accounts payable?
Yeah, and so I think for a lot of us at the early stages, the spending that we're doing is literally by credit card, right? And that's fine. Obviously, credit card gives us some flexibility. We're able to charge things. People know credit cards. Obviously, that's not going to work in all cases, and in many cases, I would say that you want to be setting up accounts payable. You want to be setting up vendors that are going to invoice us as opposed to charge us either by a credit card or by cash on delivery, right? And there's several reasons for that. First of all, it builds up the financial reputation. So, one of the things that people are going to be looking at your company at some point in time is they're going to be looking at your DUNS or your Dun & Bradstreet credit rating. They're going to want to check out the activity. So to the extent that we can establish credit earlier on, that just helps us. It's obviously better also from a cash flow management perspective, because what's better than free cash, right? Or being able to borrow money for free for a certain amount of time. And that's basically what accounts payable allows us to do, right? It allows us to work with a vendor and say, hey, I'm going to be buying stuff from you. I don't want to pay with a credit card. I don't want, or maybe our credit card has limits and we want to go beyond that. And so I want to establish credit with you. So, give me some credit terms. Let me order from you guys, and then you send me an invoice, and I'll pay within 30 days. And companies are incented to do this because it allows them to sell more to companies that don't want to be paying cash or can't pay cash, and you should take advantage of that. So set up where you can, when you're doing enough business with certain vendors, set up terms, set up payment terms. It only helps you, it doesn't hurt you in any way other than the slightest additional amount of administration that it requires to actually receive a bill from a vendor, and then obviously pay it. But nowadays, with the likes of online bill payment, with the likes of online banking, it's just so easy to do, and no longer are we tied to the old way of doing business, which is, you receive a paper invoice in the mail, you have to open it up, you have to enter it into QuickBooks, and then you have to, put it into an AP aging, and then you end up having to cut a check and send the check. So, with all that said, it's just, there's no harm in doing that. And so we absolutely want to do that. And again, the likes of QuickBooks, has all of this capability built in that will give you the flexibility. In addition to that, there's also, new services, cloud-based services like Bill.com. which will allow you to manage the payment process of AP, actually both AP and AR, accounts receivable if you have it, very, very seamlessly and very, very easily. So highly, highly recommend you use these types of services.
And that moves us right over into accounts receivable. So why don't you speak to that a little bit about how to best manage your accounts receivable?
Basically, it's the same thing, right? So obviously, if you're a company that takes payment up front, good for you. That obviously helps us, helps our cash flow. The earlier we get cash in from customers, the better off we are. To the extent that we have a business model that requires us to sell a service or sell a product where we can't collect up front, so not a SaaS model, for example, but we deliver a product or we deliver a service and then we invoice for that service, then we obviously need to set up a system to allow us to, quickly and easily send invoices, track how, who owes us what, make sure that we're staying on top of collections, not letting receivables linger, because that only hurts our cash flow wise, and I'll also argue that the longer that an accounts receivable is outstanding, the higher the likelihood that we'll never collect on that cash. So staying on top of it is critical. Put the payment terms in writing for new clients. You may think that it's understood that that we're going to invoice for it and they're going to pay up front, but a lot of times that's not going to happen, especially with bigger companies who have their standard processes of payments, and so making sure that there's an agreement as to when they're going to pay you is critical. I would also, again, urge you to use Bill.com. If you're doing something like this where you're invoicing a significant number of clients, it just makes it really, really simple to both send out invoices, set up reminders to both yourself as well as to set up email reminders to the client, to your customer, to let them know that payments are due.
Okay, so that moves us on to everyone's favorite subject, taxes. So what do early stage startups need to think about in regards to taxes?
Fun. I know. Taxes. So actually, the most absolutely important thing that you need to do is you need to file them, and you need to file them on a timely basis, right? So where we get into trouble is when we miss filings, and so this is something you absolutely need to stay on top of. And if you're not comfortable doing it, find someone who is. So this is one where even if you don't need the services of a financial or accounting service team, you probably do need to find a tax preparer, right? You don't want to be preparing your own tax returns. You can find guys, neighborhood guys who will do early stage tax returns for not very much money. You should absolutely be doing that, making sure that they understand, your fiscal year, when your tax filings are due, and how much is due, and making sure that they're filed and paid on a timely basis. The times that we've seen companies get into trouble is when they realize or when they don't realize when filings are due, and that's why you need to stay on top of it. So if you're going to do it on your own, which I discourage, but to save money, I understand that some companies will do it. Just make sure that you understand when these filings are due, and make sure that you're doing them on a timely basis. Once a year you've got to do 1099s. The IRS will impose severe penalties if you are supposed to be filing 1099s and you don't do it, and they do it actually on a per instance basis. So if you have, and for those of you who don't know, 1099s are for when you use individual contractors to perform some services for you, and you pay them cash and you don't withhold taxes, then you need to be reporting this. And it's to any contractor, individual contractor that does more than $600 of service for you within a calendar year. For every one of those consultants or contractors, you need to be sending them a 1099, and then you need to be filing with the IRS within 31 days. So by January 31st, after the calendar year end, you need to be filing. You need to be sending the 1099s to your contractors, and you need to be filing with IRS. And for every instances that you don't, then you'll receive a per instance penalty. So you need to stay on top of that. Payroll taxes, you should not be doing payroll on your own. It's just too easy and too cost effective to use the likes of Intuit or Zen Payroll or somebody like that, or ADP or whoever it is. But use a payroll service provider if you have payroll. They will be responsible for withholding payroll taxes and filing payroll tax forms for you. Absolutely, this is one area where it makes no sense for you to be trying to do payroll on your own. The first point up here is just the correct legal entity, and this is the difference between a sole proprietorship, a partnership, an LLC or a limited liability company versus a full corporation or a C corp. And this is one where it just kind of depends on the kind of company that you are, what kind of financing you're going to need in the future. And the tax considerations. So that probably requires a little bit more in-depth discussion, probably more than we want to be covering here. If this is a topic that you need more information on, there's a lot of information online, obviously, and I think we probably have some information on our website in past presentations that discuss this as well. So you want to set up your company with a right legal entity for not only now but going forward as well.
Yeah, we absolutely have some articles on this, so you can just go search our blog. And if you have any questions, feel free to write comments or ask us, and we'll be happy to make clarifications. We also have a question here from Vicky. She wants to know, when should a startup choose a fiscal year that is different from the calendar year?
So there's a couple reasons why you might do it. I would say in most cases there really isn't a very, very strong reason. The reasons that you might want to do it, there could potentially be some cost savings because to do tax returns, for a calendar year, fiscal year, which means that your fiscal year ends on December 31st. And that your tax filings, your initial tax filings are due on April 15th, and then you can file an extension and actually delay your filing until September 15th. But the problem, the issue is that most tax preparers are obviously busy during those times because that's when they're doing the bulk of their work. So if you have a different fiscal year, let's say for example a June 30th fiscal year, then obviously in those some months are slow months for accountants and tax preparers, and so you might be able to get your taxes done for a slightly cheaper rate because accountants and tax preparers might offer you a better rate during that time. There might be some corporate reasons. So for example, I know some companies who, for example, didn't start their company or didn't start their revenue until July or August, for example, right? And so they don't want to do a December 31st fiscal year end because then they're going to have to file tax returns earlier than even their full first year, and they just rather delay that until they've kind of been in business for a full year, and so just kind of pushing out kind of the deliverables as well as any kind of payments and things like that for 6 months. So I've seen people do that, but really for most startups I just don't see those as being compelling reasons. Instead, what I would say is that I would be more worried about having a different fiscal year than a calendar year in terms of really understanding when those deadlines are, because obviously all those deadlines change, and making sure that you understand what those are, as opposed to if you're on the calendar year, then you can go online at basically any place and you can see all the deadlines that are coming due because they're listed everywhere online.
Okay, thanks. So financial projections. Can you talk through these a little bit, and also especially point out the differences between what's a bottom-up projection and a top-down projection, and maybe when you would use each?
Sure, absolutely, and obviously, financial projections. What do we need them? What do we need them for? Obviously, it helps us manage our company. It helps us manage kind of, what our revenue looks like, what our gross margins look like, how much, what our expenses look like, and our financial projections help us plan, right? And that's really the goal. But also, in addition to that, you're not going to be able to raise money without financial projections, right? You're going to have to show financial projections and a way that you're going to start making money in the future, as obviously a vehicle for investment from outsiders. So they're obviously critical. When you start doing financial projections, is obviously it's kind of depends on the company and where you're at. But really, when you do financial projections, there's several things that you need to look at. You need to look at your revenue projections, right? You need to start with that. And in order to get to that revenue projections, you can do a couple of different things. And here, we talk about doing, top-down projections and bottom-up projections. Top-down projections basically start with a market size. And I'm going to use a couple of acronyms here, but there are things like TAM and SAM and SOM. And TAM is the total available market, and so you kind of start with this big market that you're going after, right? And then you kind of funnel that down into a serviceable available market, which is a SAM. And then you funnel that down even further to say that it's a serviceable obtainable market. So you use things like, it's kind of the comparison. I think one of the startup books, talks about, sushi, right? Well, the worldwide market for sushi might be $10 billion, but if you're opening up a sushi bar, in San Jose, your serviceable market might be, $5 million, because that's the radius of 5 miles from your restaurant. And so, you got to kind of, extrapolate down from the total available market down to what you think you can actually obtain. And so then that's kind of the revenue potential of your company and the particular niche that you are going after at this point in time. Now, that's not to say that you're stuck in that niche, but when you're kind of doing a financial projection, you want to understand, okay, this is the niche I'm going after, this is the time frame I have, and in order to get to this revenue, now you have to kind of start doing a bottoms-up projection in terms of, okay, to be able to service this kind of revenue base, what kind of people do I need to hire? When do I need to hire them? How much product development do I have to do? What are my customer acquisition costs? What kind of capital expenditures do I need to buy? What kind of services am I going to need, both from a product perspective, customer perspective, but also a general or administrative perspective. So things like, accounting systems and financial assistance and legal assistance. Do I need to be filing patents, and how much is that going to cost? So these are the types of kind of bottoms up projections that you kind of need to start thinking through once you come up with, what you think your revenue is going to look like over the next, several periods, and the timing of that revenue kind of depends on your company, but certainly you need to be doing an annual plan, and on a regular basis you need to be doing a long-term or a 3 to 4 year plan as well.
Great. So we have a question here from Eddie. He just wants to know your take on bootstrapping versus seeking outside investment capital.
Great question. Great question. And I think first of all, I'm sorry, was it Eddie?
Yeah.
Eddie, I would encourage you to continue to look at our schedule. We do kind of fundraising basics webinars regularly. And so, this is a classic discussion that happens during that presentation. So I know we have past ones that you can look through, and I know we'll be holding future ones as well. So we certainly encourage you to attend those. But really, yeah, so bootstrapping versus outside funding. It's typically both, right? I mean, you can't start by outside funding. You're gonna have to do some bootstrapping, and for me, bootstrapping means two things. One is using your own funds, and then obviously using the cash flow from operations to help you grow the company. And it's limited, right? I mean, you want to do it as much as possible, because The earlier that you raise external funding, the more expensive it is. The more you're able to do before you raise money, the less expensive that next round of financing is going to be. So I absolutely push and encourage entrepreneurs to do as much as they can by bootstrapping a company for as long as possible, putting in your sweat equity, putting in a little bit of money on your own to help get the company started, develop the product, start getting some traction, and really, getting external funding should be a means of growth, right? It shouldn't be to validate the market. It shouldn't be to validate the product or the service. You should be doing that on your own nickel and with your sweat equity and by bootstrapping. To the extent that you can kind of, pull that along, and the company is now producing revenue, and you're using that revenue to help to grow the company. Again, the longer you can go by doing that and growing the company, the better off you're going to be. When you want to raise external funds is when that's not sufficient. When you have a market opportunity or business opportunity that's big enough where you know, hey, listen, if I had some additional cash, if I had several $100,000 or $1 million or two, that I could really accelerate the growth of my company, accelerate the revenue, accelerate the user acquisition, whatever it is that you're trying to do, that's when you should be looking at external financing.
Great, thanks. So we're moving on. I thought we were at the end. Whoops, to financial reporting. So, what are some thoughts about financial reporting?
Yeah, and this is where, this is, again, obviously now you've got an accounting system set up, you've got investors, and you basically have, the three classic financial statements, right, which is the income statement, the balance sheet, and the cash flow. If you don't have an accounting system set up, I can guarantee you that it's going to be a nightmare trying to do this. So if you try to do something like this in Excel, for example, no, it just doesn't work. So use an accounting software. But those three statements make up basically the absolute minimum that investors are going to want to see. And it also gives you kind of visibility into what's happening. It gives you a trend analysis on your revenue. It gives you a trend analysis on your expenses. It shows you how much cash you're burning on a monthly basis, and it shows you what's happening on your balance sheet in terms of working capital. So I recognize that these are terms that you may or may not be familiar with. It's a little bit hard to go into all those kinds of details at this high level, on this kind of a high level introduction to startup accounting. But those are some of the things that you're going to be able to see once you start preparing these financial statements. In addition to that, absolutely one of the critical things that you should be looking at is BVA, or budget versus actual reporting. And this is where we had talked about in a previous slide that you put together a financial plan, right? And you say, okay, this is the revenue projection I see. This is the cost of goods sold for that revenue, and then these are the expenses that I see going forward. And you kind of put that in place, and you say, this is my annual plan. This is what's going to happen over the next 12 months. And then on a monthly basis, as you start preparing your financial statements, you need to compare those actuals to what you had in your budget, right? Because obviously there's a lot of information to be gained by that. First of all, it tells you how you're doing in relation to your budget. It gives you a monthly advance warning as to whether you are undershooting or overshooting what you thought you were going to be doing. It obviously gives you a quicker visibility into whether the amount of cash that you have is going to last as long as you thought it was going to last, and whether you need to be making adjustments or whether you need to be pulling in your timetable in terms of raising additional funds or maybe cutting expenses. So it's a great management tool as well as a reporting tool that you should be looking at least on a monthly basis. Well, I say at least on a monthly basis because I'm a finance and accounting guy. As an entrepreneur, you may not need to do it on a monthly basis. You may have a very, very simple model that where you really know on a monthly basis, hey, it's just me, a co-founder, one employee. I don't have any revenue, so I don't have to worry about doing a BVA against revenue. I just need to make sure that my expenses are kind of in line with what I was expecting. And as long as you kind of, if you know enough about your business to be able to say that, then maybe you don't need to be doing this on a monthly basis. But I still encourage entrepreneurs to really, really keep their fingers on the pulse of what's happening financially. And the way that you do that is you do monthly financial reports and you do monthly BVAs. And then other financial reporting, it just kind of depends, like I said, on what the key metrics are for your company. You should be putting together at some point in time, those, what we call financial dashboards, KPIs or key performance indicators, and tracking those. And whether it is, it may be, for example, number of users. It may be the cost to acquire a customer. It may be, the average value of a customer, or how much each customer is paying for our service or product. Whatever it is, you're the entrepreneur, you know the business, you know those metrics that need to be tracked to make sure that your company's still on the straight and narrow with regards to getting to where you need to get to, and so put those in place and track those. There is nothing like putting in actual metrics, putting things in writing, and tracking against those to really give you the sense of urgency, as well as knowing that you're going to be tracking it, and not thinking of something that's nebulous out there that where you say, I think we're kind of in line with where I thought we were going to be. That's not good enough if you really, really want to manage your business to success.
Great, thanks. So, I mean, that takes us to the end here, and I think we've covered a lot of ground. So I don't know if you want to kind of add anything that maybe we didn't cover that you think is really important to share with this audience, or just kind of summarize what we've discussed here. Final thoughts?
Yeah. I think really what it comes down to is just like with any other decision that you're going to be making for your company. This is just something that you need to think through. You need to figure out kind of what you're going to be doing. Thinking about where you are today as where you're going to be a year from now, 2 years from now, 5 years from now, and putting in processes and services to bear on that problem, on those problems. So it's just like anything else. You'll feel pain points, just as with hiring, with product development, with customer acquisition. You're going to do a lot of this on your own. I encourage that. I absolutely do. Say save your nickels, save your pennies, right, for the important things. So don't be spending money when you don't need to be spending money. Don't be hiring outside contractors earlier than you need to. But at some point, you are going to feel the pain, and when you do, then I highly encourage you to leverage yourself in the best manner that provides value to your company. And I can guarantee you that is not going to be spent 5 to 10 hours a week or how many ever hours per month trying to figure out how to enter transactions into QuickBooks and how to prepare financial statements. Get outside assistance. The other final kind of takeaway, and I realize that this is more about accounting, but there were a couple of questions raised about fundraising as well. And as you look forward, pick your partners, and this isn't part of this presentation, but I get asked this all the time, and pick your partners carefully. Pick them carefully early on. So if you're a company that's just starting out, you're doing some bootstrapping, but you're going to be growing your company, you're going to be out there looking to raise funds, then think about that now, right? You need to start your network now. You need to work with players within the ecosystem that caters to early stage companies that are ultimately going to go out for outside investments. So working with people who know investors and who can make introductions. Work with bankers who are knowledgeable about working with early stage companies and who can not only help you with fundraising at a later date, but who can also provide debt for smaller companies and early stage companies. So, you know, the guys like Silicon Valley Bank or Square One or Comerica for early stage companies are much better fits than the Bank of Americas and the Chase banks, for example. You know, work with attorneys who are knowledgeable about startup space and again can make introductions to you when the time comes and also help you set up the legal formation documents and all the stock option documents because they know that this is what early stage companies do. And you know, to put a little bit of a plug for early growth financial services, you know, when the time comes, work with an accounting firm that is focused on your space. You know, you can obviously go to a Big Four or a regional accounting firm. They're going to be more expensive. They're not going to know the intricacies, not the intricacies, but kind of some of the sensitivities of working with early stage companies. You know, companies like us, and there are others as well, but they know what early stage companies need. You know, we're not going to overcharge you. You're going to get great value for the dollars that you spend. And when the time comes, we're part of the ecosystem that provides value in terms of not only our service that we provide, but possibly the introductions that we might be able to make for you on your behalf to potential investors. So keep that in mind. Every service provider that you're working with should be able to provide more service than just that service that you're buying.
It's a great point, Sirk. Thank you so much. So that takes us to the end here. You know, we've had a few individual questions from folks that are really particular to their businesses. So I'm not going to actually ask that here, but we'll follow up. If you've asked one of those questions, we will follow up with you. And just so you know, if you've been listening to this presentation and it's raised questions about your particular business, please just go to our site. And I mean, you can use the contact information here, but you can also go to our site and there's a contact us link. And if you fill that out, fill out that form, someone will contact you for a free 30-minute financial consultation so that you can talk more in depth about your own business and your own challenges and you know what you need and what your needs are, and we can see how we can help you to sort things out in a more customized consultation as opposed to this large-scale webinar. So I encourage you to do that. Just click on Contact Us form. And if you, I'm hearing feedback, sorry. And if you have other questions about some of the topics we've talked about here, feel free to look at our blog. We have a lot of information there. So on that note, I'm going to, sorry, I'm hearing feedback. I hope you can all hear me okay? Okay. So that takes us to the end here. So I just want to let you all know that we really appreciate your time and hope you found this to be useful. And we hope to connect with you again at one of our upcoming webinars. Our next one is scheduled for September 4th. It's Startup Pitch Decks that Work, Creating a Winning Pitch Deck. And that's going to be another hour-long free webinar with Mark Phillips from Arafura Ventures. So he has his own VC firm and he's also an entrepreneur, so he sees it from both sides of the table. And we'll also have Jim Fulton from Cooley, and Sirk will be joining them as a panelist as well. So if you go to our site, you can check out our events page to see more information about this and other upcoming webinars and to register. So we hope to see you at that one or another one soon. And if you have any follow-up questions, please do reach out and check in with us. So thanks again for your time, and thank you so much to you, Sirk.
And thank you all for attending. I know your time is precious. I know if you signed up for this presentation, you guys are at a wonderful stage, in your career, starting a new venture or really getting off the ground. So I congratulate you on what you've done so far, and obviously wish you the best of successes. And thanks again. I know this is a little bit of a dry topic, but one that's definitely a necessary evil and one that you want to get right from the very beginning. So thanks again, and I hope that I'm able to communicate with you guys again soon.
Great. Thanks so much. Have a great day, everybody.
Thanks, Erica.
Bye-bye.